Something impossible just happened in the US housing market, and nobody is explaining the part that actually matters. So, yes, mortgage rates dipped. Yes, applications spiked. But the real story isn't the rate cut itself, it's the system behind it. A system that quietly signaled it's running out of oxygen. Because if you've been watching your rents rise faster than your paycheck, or staring at home prices that look like they were generated by a malfunctioning algorithm, you already feel it. Something deeper is happening underneath the surface. And you're not imagining the pressure. You're living inside the most engineered housing market in modern American history. And here's the truth economists won't say out loud. This wasn't an accident. It was the model. Because when affordability collapses, someone always benefits. And it's rarely the family trying to buy their first home. So today we're breaking down the part the headlines won't touch. Mortgage rates didn't simply come down. They were pushed down by the same forces that inflated prices, distorted demand, and propped up the illusion of stability heading into 2026. And this matters because these moves don't just affect the house you buy. They affect the taxes you pay, the insurance you're charged, and the maintenance you can't avoid, the debt you're locked into for decades. And you're not looking at an interest rate, you're looking at a survival equation, for lack of a better way of putting it. Because first, the truth behind the rate movement, like mortgage rates didn't fall because the economy is super strong. They fell because the bond market blinked. So when Treasury demand softened, mortgage-backed securities had to reprice to avoid the liquidity freeze. Now, the system isn't relaxing, it's bracing. Now, builder rate buydowns aren't gifts. They're distress signals. Builders are holding record inventory, record debt, and record carrying costs. So a 4% teaser rate costs them less than a price cut. And it keeps appraisals artificially elevated. It's like a car dealer offering free tires so you don't notice the engine warning light. And that 31% jump in mortgage applications, that's not real demand. It's a rate dip rush, a temporary surge every time financing becomes slightly less painful. It's the Black Friday version of home buying, a frenzy created by scarcity and urgency, not affordability. And no, this is not a true buyer's market. It's an affordability desert with slightly more shade. Now, inventory isn't rising because sellers suddenly feel generous. It's rising because buyers are tapped out. Insurance is exploding, taxes are climbing, maintenance inflation is brutal, and real wages haven't kept up. Now, adjust for those costs, and the buyer pool is the smallest it's been since the mid-90s. Meanwhile, cities cutting impact fees and loosening zoning restrictions isn't a grand push towards affordability. It's a financial necessity. So municipal budgets are strained right now. Construction is slowing and tax bases are eroding. Cutting fees isn't charity, it's a survival maneuver. So imagine a restaurant offering 20% off, not because business is booming, but because no one walked through the door. So there's also a misconception about the labor market. Housing costs aren't rising because workers won't show up. They're rising because developers financed land at peak pricing. Materials are inflation indexed. Insurance is crushing margins, and lending costs are the highest in a decade. Labor is a symptom, not the cause of the affordability crisis. And then there's the credit issue. You may have heard that it's becoming easier to qualify for a mortgage, but the reality is more complicated than that. Lenders still require credit scores. Fannie Mae simply expanded what counts as acceptable financial history because first-time buyers have been wiped from the pipeline. It's not generosity. It's an attempt to keep the the engine running. It's like a college lowering admissions requirement because applications collapsed. Not to help you, but just to stay alive. And the talk of dividend checks, rebates, and direct-to-consumer benefits doesn't change the structural reality of all this. A one-time stimulus barely touches the real cost of ownership. It doesn't make housing cheaper, it makes debt easier to swallow. But the biggest red flag is the growing push for ultra-long mortgages. A 50-year mortgage isn't innovation. It's a sign of a system stretching affordability to its breaking point. It makes the payment smaller, but the cost much larger. It's like stretching pizza dough so thin you can see the table underneath it. And it's bigger in appearance, but emptier in actual substance. And here's what no one's actually really saying. The system isn't lowering rates because homes are becoming affordable. It's lowering rates because it cannot allow prices to fall. If prices correct meaningfully, banks take losses. If banks take losses, the bond market cracks. And if the bond market cracks, the mortgage machine stalls. So instead of resetting prices, they just reset you. Your expectations, your payment, your timeline, your financial future. Housing doesn't get cheaper. It just gets repackaged. And this is the part most people never see. The real costs continue rising even as the rate headlines look friendlier. Insurance premiums are skyrocketing. Property tax assessments are quietly resetting at the peak. Maintenance inflation is now higher than the CPI. HOAs are raising dues nationwide. This is the hidden homeowner squeeze, the part no mortgage ad will ever mention. So what does this moment actually mean for us? Well, builders will push deeper incentives. Lenders will engineer more creative financing, and headlines are going to say affordability is improving. But the real cost of carrying a home will continue climbing. Make no mistake about that, because in a system built on housing debt, someone always gets paid, and it's rarely the household. And here's the twist, right? Because mortgage rates weren't the real crack. They were the warning shot. The next fracture forming in this system isn't in home prices. It's in the banks behind the mortgages. And that story begins on another episode. But in any event, guys, put your comment in the section below. I look forward to reading and replying to your guys' comments. And thank you again so much for joining me here on The Baseline. All right. Cheers, everybody.